All right, everybody. So let's have a conversation about dividends versus capital gains. It's important we understand these, especially when it comes to making the right choices for efficient investing for your situation. Again, everybody's in a different situation. Some people, capital gains structure investing is better than dividend, income, yield structure. Okay. So let's make sure we understand when and where to use these things so we can be as efficient as possible. So let's start with the basics, just so we get an idea of things. Pretty much 50% of all stocks pay dividends, 40% in the US, 60% internationally. Dividends and capital gains are both types of investment income, but they differ in how they're earned and taxed. Okay, and that's what makes this different in terms of choices for investment portfolios. Dividends, okay, these are profits the company makes. Okay, so it's good to understand where these come from, right? If you own a share of stock from a company and they profited and they choose to pay out those profits in the form of dividends, they basically divvy it up to all the shareholders. Okay. This is usually on a regular basis. There's a dividend, ex-dividend date declared, and they pay them out. Okay. You then receive those dividends and you're allowed to then reinvest them any way that you want. Capital gains, however, okay, this is very simple. You buy a stock, it goes up in value. The difference between what you paid for it and what the current value is your capital gain, hopefully not a capital loss. And there are two different types, long-term capital gains and short-term capital gains. Capital gains can be earned on stocks, real estate, and plenty of other assets as well. So it's the appreciation in value. That's the capital gain. So now let's break down the difference in taxation because this is where the rubber meets the road. Okay. Dividends. Okay. Tax rates for dividends depends on whether they are ordinary dividends or qualified dividends. This is so important to discern the difference between the dividends that you're receiving. Qualified dividends are usually taxed at capital gains rates, much lower taxation, which I have on the next slide. Okay. Whereas ordinary dividends are taxed at your full income tax rates, the highest tax rates that you're typically going to see. Okay, so to be qualified dividends, they have to be paid from US stocks and held more than 60 days during the 121-day period, which starts 60 days before the ex-dividend date. What does that mean? You can't be buying and selling and buying and selling. For instance, when you own a mutual fund, you can't control what that manager does. And quite often, they're going to hold it to get the dividend and then sell it. And then they'll go buy a international stock, get that dividend, and they'll move over and buy a US stock and get that dividend. And so you end up changing all those qualified dividends into ordinary dividends and pay higher tax rates. So you've got to be careful about these dividends. It's got to be a US stock and it's got to be held all the way through that dividend date for at least 60 days. Then there's capital gains. And again, capital gains, you have a short-term capital gain versus a long-term capital gain. Short-term capital gains are taxed at your ordinary income tax rates. Those are higher than long-term. Long-term is holding an investment for more than a year, buying and selling with more than a year in that time period. And then you will be taxed at the lower tax rates on the next page. Okay. The other part that we have to understand about this is when they are earned, right? The biggest difference when it comes to you and your choice of investing strategies is this part, right? If you're getting paid dividends, you're getting paid dividends and you owe taxes when you get paid those dividends. Whereas capital gains, you're only going to owe that taxation when you sell the investment. So you're going to be able to control the taxation on a capital gains structure much better than you can control it on a dividend structure. So think about it more like this. If you're in retirement and you want to spend that yield from your portfolio, you're trying to create that so it's paid out to you so you don't have to sell the stock. So that way volatility isn't going to bother you as much, right? So dividends are great for people that are actually going to go spend that money. Whereas capital gains structure, for instance, maybe a retiree that doesn't need that income, and they're looking at more building wealth for future or maybe for your heirs, but it's money that you're not going to need on a year-to-year basis. Then you're going to want to go more to that capital gains structure. Okay, so that's important to understand. This is about being as efficient as possible with your own individual situation, and choosing the right type of investment structure becomes very important. So then when we look at these tax rates, we need to understand how they apply to what situation. Okay, so these charts are pretty simple. They include the standard deduction. They're using 2024's tax rates. Straight from the IRS. Qualified dividends and long-term capital gains are taxed on this tax bracket, separate from your ordinary income. Now, the confusing part for a lot of people is that means that I get 61,000 of capital gains at zero? No, not necessarily. Your ordinary income is added up and taxed first, and you start on this chart after your ordinary income. Okay, so if you had 50,000 in ordinary income this year as a single person, then you have 11,000 worth of capital gains. You start here where you left off on your ordinary income tax bracket. And that's the confusing part on our taxation. So just because you're married doesn't mean you have 123,000 of dividends at zero taxes. No. If your total income, including long-term capital gains and qualified dividends, is less than 123,000, then you will pay zero on your capital gains and dividends. But it all has to fit within that number. And then we're only at 15%. And when you look at ordinary income tax rates, those are much higher tax rates. So when we look at that tax bracket, we say, okay, wait a second. All the way, I'm paying 10 and 12% over here. Over here, I'm paying zero. Whew, I like zero. Whereas when I start paying 15, I'd be paying 22 and 24 over here. Holy cow, that's a big difference. I'd rather pay 15. Again, very tax advantaged. Long-term capital gains and qualified dividends, you will pay much less taxation. But here's the confusion for a lot of people right here. You see IRA money? If you earn a qualified dividend in an IRA, it doesn't matter. You're going to get taxed the full tax rates. The IRA overrides the long-term capital gain and qualified dividend. Okay? So if the money is in an IRA, it doesn't matter whether you're earning a qualified or ordinary dividend. It doesn't matter. It doesn't matter whether it's a short-term capital gain or a long-term capital gain. You're always going to be taxed on the ordinary income tax bracket. Okay, so qualified dividends and long-term capital gains in after-tax non-qualified money get tax advantages. They don't when they're in an IRA. And then you can see the ordinary dividends, not the qualified, the ordinary dividends, and the short-term capital gains are taxed at these much higher tax rates. Okay, and if you're lucky enough to have Roth money just gets taxed at zero. As long as you've used it properly, you've invested it properly, you waited your time period, you're over 59 and a half, all those wonderful rules that you got to follow. If you follow the rules, it doesn't matter whether it's a long-term capital gain, a short-term capital gain, a qualified dividend, a non-qualified dividend, an ordinary dividend. It doesn't matter what it is. It's all taxed at zero if it's in your Roth. Okay? So tax rates and what type of money you're using will change how you're going to invest. And that's what a lot of people, especially as they transition into retirement, their portfolio needs to adjust. Owning a mutual fund in a Roth account or in an IRA has no effect on your taxation, whereas owning that mutual fund over here in your non-qualified after-tax savings, and that mutual fund manager is buying and selling, you're going to move from qualified dividends and long-term capital gains to ordinary dividends and short-term capital gains, and you're going to pay higher tax rates. So you typically don't want high turnover investments in your non-qualified after-tax savings. So that way you're able to buy and hold and take advantage of the much lower tax rates. So this is very complicated for a lot of people, and tax management in your portfolio becomes incredibly important, especially the more money that you have. Most people heading off into retirement, it's crazy. They have mountains of IRA money and they put their head in the sand and do nothing. You have to have a plan. Being efficient is so important, and your choice of dividend paying stocks or dividend paying investments versus interest paying investments versus long-term capital gains, buying and holding and selling for a profit. These are all choices that you have to make, and you have to make them in the right parts of your portfolio. Treat your IRA money different than you're going to treat your after-tax money. Treat your Roth money different as well. So important we understand these rules and build these portfolios so we can be as efficient as possible with our own situations, because you are different than anybody else. I hope that helps. This is what I do, what I love. I get passionate about it. Tax planning has to be very integral part of everybody's retirement plan as they head off into retirement, making sure that you're as efficient as you can be, so you're not wasting money to taxation and fees and just inefficient investing strategies that have nothing to do with your situation. So think through this and make sure that you have good advice, not just generalized advice for the world, because people that don't know exactly what they're doing and everything about the investing world take generalized information and somehow think it's meant for themselves. And if applied improperly, it doesn't work and may cause problems. So everybody's different. You got to have your own plan. If I can help in any way, this is what I love doing, making sure people are as efficient as possible. Yourinvestmentcounselor.com. You can always schedule appointments with me. I've got a 30-minute free meet and greet on there. We can chat about your situation. And certainly I'm happy to work hourly as well. I'm not that typical advisor that just wants you to give me everything. I don't need that. I'm happy to do it, but I'm also here happily hourly as well. We also do full classes. If you haven't found them, fpfeaz.org. You can jump on that website, find our full class schedule. We do a different topic every month. We have 3 or 4 different opportunities to watch those classes. 800-345-3155. Subscribe. The channel is full. We've got over 10,000 subscribers. We've got over 200 videos, 250 videos, I think now. And we're going to be adding our CPA corner as well. A lot of people love taxation, and we're very quickly approaching tax season. All right, everybody. Have a great one. We'll see you next week.